In today's video, we are going to deal with ordinary shares. An ordinary share, or rather an equity share, it gives you a unit of ownership in a company. As an investor, if you buy a share in a company, you become a part owner. And the company can be private or public listed company. A private company is privately owned and does not trade its shares on any stock exchange, while a public company trades its shares on a stock exchange. One, as an investor, when you own shares in a given company, you get voting rights. The other benefit is that you enjoy limited liability. What do I mean by limited liability? It means as an investor, you are not affected by laws or obligations of that given company. Another benefit of owning shares is financial gain. Financial gain comes in two ways. One, you get to enjoy share appreciation, where basically the price of a share is rising. If you sell, you tend to enjoy capital gains. The other financial benefit is you enjoy dividends and bonuses when a company has made profits. So, as I've said, public listed company shares are traded on a stock exchange. A stock exchange is basically an organized market where buyers and sellers of shares meet. So, if you're an investor, you want to buy shares, you can go to an exchange and buy shares. If you are owning shares and you want to sell them, you sell them through a stock exchange. So, and examples of stock exchanges are the Nairobi Stock Exchange, Johannesburg Stock Exchange, we have the London Stock Exchange, New York Stock Exchange. The exchanges are very many depending on the region of the world that you are in. In our case, we are going to talk about Nairobi Stock Exchange, which is also known as NSE, and it was founded in 1954. One, stockbroker. Why do you need a stockbroker? Stockbroker, basically, these are professionals who are going to give you informed advice on which stocks you can invest in, when to buy or when to sell them. Because this is a professional thing they've done, and they know when you can make money and when you can lose. So they are going to advise you on which stocks to buy or sell. To find out the licensed stockbrokers in Kenya, you can visit our webpage on Finance EA. So basically financeea.com, and you can find the licensed stockbrokers in Kenya. So these brokers are regulated by CMA, which is the Capital Markets Authority. If you go on your browser and type in financeea.com, you'll find we have a tab for financial agencies. On this tab, if you scroll down on the options, you'll see NSE listed, or rather licensed stock brokerage firms. Click on it. When you click on that, you're going to see a list of brokers. These brokers are regulated by CMA, as I've said. You can find out whichever one that you're going to use. So the best thing, if you want to choose a nice broker, look at their online presence, look at online reviews, and also look at the commissions. It's very important when using a broker, get a broker who's not going to charge you a lot, because you don't want to be spending a lot of your money on commissions. The other thing is I'll expound on is the trading account. So basically, when you find a broker, they're going to show you you're going to get a CDS account. They'll help you open that. And the other thing, the very important thing you need is money. If you want to buy shares on the NSE, you need money. Once you've opened your online account, you need to transfer in cash. So the question is, how much money do I need to start trading? Now, that question will be answered by the type, or rather the counter you're going to invest in. Because remember, on the NSE, we've got different companies. For example, we have Safaricom, we have KQ, we have Equity Bank, Coop Bank. There are very many companies. If you want to see the companies, also you can visit our site on Finance EA. We've listed all the companies that are listed on NSE. The last thing I want to expound on is money. Definitely, to invest, you need money. How much money do you need to start investing? So this will depend on the counter that you choose, and it will depend with how much money you have. So I'm going to do a mathematical illustration on how much money you need to invest in NSE. This is the first example. We want to know how much money one needs when they want to invest in the NSE. And this is what we're going to do. Since we said the minimum number of shares per counter on the ET normal that you require is 100 shares. So we are going to assume an investor is going to invest the minimum 100 shares on ET normal. Our brokerage fee 1.7%. So in this case, if we are assuming that an investor wants to buy Safaricom share, the price on and we are going to use the price that was there on the 3rd of October 2023, which was Kenya shillings 14.7. So we want to know how much money you'll need or you have required on that day to buy 100 shares of Safaricom. So this is the amount of money. You take the number of shares, which is 100 shares, times the share price plus commission. This is going to be 100 times 14.7 plus 1.75% of 100 times 14.7. 100 times 14.7, that's 1470 plus 1.75% of 1470. If you use your calculator to do that, you're going to end up with Kenya shillings 1,495 shillings. So as you can see, for you to have bought 100 shares of Safaricom on the 3rd of October 2023, where the price was 14.7, brokerage fee 1.7%, you'll require to pay 1,495 Kenya shillings. That is for the minimum shares on the ET normal. Let's do an example using also BAT. And we are using the same date. The minimum share here, still 100 shares. The brokerage fee, as we've seen, 0.75%. And the price as of that date was Kenya shillings 420. So we are going to do the same thing that we did for Safaricom. That's going to be 100 shares by 420 shillings plus the commission, which is going to be 1.75% of 100 by 420. So this is going to be 100 by 420 is 42,000 plus 1.5% of 42,000. If you use your calculator, you're going to get Kenya shillings 42,735. So as I was saying, money will depend on which share you're buying. If you're going to buy a minimum shares of 100 for Safaricom, it's going to cost you 1,495. For BAT, it's going to cost you 42,735. So the minimum amount you can start with depends with the share you choose. It also depends with your risk appetite and the amount of money that you have. So let's have a look at long trading. Basically, in the long trading is a strategy where you buy equity shares when you're expecting the prices will rise. So the simple exit action here is you buy at a lower price, sell at a higher price. And we normally adopt this strategy of long trading when we know the market is bullish. So in a bullish market is where we're expecting the prices of stocks are going to go up. So I'm going to show you also an example of how a long trade works. I've said where we buy low and sell high. The exit strategy here is to make a profit when prices are high after we've bought them at a low price. Let me show you an example of how a long trade works. This is an example of a long trade, or rather long trading or going long. So we said when you're doing long trading, our aim is you buy low, sell high. The exit strategy is to make a profit when the prices of the share is going high. So an example we are going to use, an example is, let's use Safaricom share. Escom, that's the ticker. So on the 12th of June, 2023, the price of Safaricom was 15.10. And on July, 10th of July, same year, the price was Kenya shillings 19.51. So on the long trade example, we are using Safaricom as our example, and in this case, we've taken historical data. So if you bought this share on the 12th of June at 15.1 shillings, and later sold it on the 10th of July, same year at 19.5, that's a perfect example of a long trade. So how do you make money on this trade? So we bought it at, and we're assuming here that you bought 1,000 shares. And also the brokerage fee we are using here is, brokerage fee is 1.75%. So investor bought 1,000 shares at 15.1 Kenya shillings, and the fee is 1.75%. So how much did they pay? That is 1,000 times 15.1 plus 1.75% of the total amount, which is 15,100. So if you use your calculator to do everything, you're going to find that they spent 15,364 to buy the shares. So, and they sold them on the 10th of July 2023. So this is how much they got when they sold these shares. That's 1,000 shares sold, and they were sold at 19.51. That gives you a total of 19,510. However, we need to deduct the brokerage fee from this amount. So what the investor is going to get in the account is going to be 19,510 minus 1.75% of the entire amount. Use your calculator. You're going to see that the investor received 19,169 Kenya shillings. So profit is going to be selling price, or rather the revenue they got after selling the shares minus the amount they spent while buying. So that's 19,169 minus 15,364. We have a profit of Kenya shillings 3,805. So basically on the long trade, you buy low, sell high. Bought at 15.1, sold at 19.51. Our example, we've assumed it was 1,000 shares and the brokerage fee was 1.75. So that's an example of a long trade. The next trading strategy is called short trading, or we can say going short. So in this example, when you hear an investor wants to go short, they first sell the shares at a high price and buy them back at a lower price. So how is an investor going to start selling what they don't have? In a short trade, what you do, you first borrow the shares from your broker. You borrow them today, and then you sell them today at a higher price and expect that the price of this particular share is going to fall at a future date. Then, when it falls, you buy it and refund it back to the stockbroker. So, also, I'm going to show you an example of how this works. So, in short selling, which is a bearish market, you want to borrow shares today at a higher price and sell them at that high price. When the price goes down, you buy back the share and return it to your broker. Let me show you an example of how short trading happens. So basically, we've said when an investor goes shorter, I'm just going to use a diagram to illustrate what happens. So this is going to be our investor who's short selling. So let's call them short seller. And this is the exchange where stocks are bought and sold. And we have our broker who facilitates these transactions, broker. So remember, we've said in short selling, a client or rather an investor, they normally borrow from their broker. They borrow when the stock is high, sell it now at that higher price, and later on, when the price of that stock falls, they buy it and return it back to the broker. So step one is step one is going to be where the short seller borrows. They've borrowed 100 shares. And let's assume the price right now is also 100 Kenya shillings. So they've borrowed this stock from their broker when it's trading at 100, and they sell it now, which is step two. They sell now at 100 Kenya shillings. So what we've seen, they've borrowed 100 shares and sold the shares, meaning they've made 100 times 100. That's 10,000 Kenya shillings. And remember, when you borrow, the broker is going to charge you either an interest, and also you're going to pay commissions. So this amount, you're going to get 10,000 less commission fee. Right now, we know you have 10,000 less commission fee. Now, we've said in short trading, you're expecting the price of the share to go down. When the price goes down, let's assume it has gone down to 90 shillings. The next step, the short seller is going to buy. This is step 3. They're going to buy back the 100 shares. And we've said the price right now is 90. They're going to buy back the shares at 90 bob. Once they've bought back the shares, what they do is they're going to return back to broker, which is our last step, which is step 4. So when they buy back these shares, it means they spent 100 times 90, which is 9,000 plus commission fee. So you can see in this case, this guy is making a profit is going to be 10,000 less commission fee minus 9,000 plus commission fee. So apparently you've seen, if these are like terms. So we can see clearly this guy is making a profit of 1,000 something on this trade. So we've said during the short trading, one, short seller, since they don't have the shares, you cannot sell what you don't have. You have to get them somewhere. They borrow them from their broker. The broker has given them 100 shares while they are trading at 100, and they sell them immediately at the prevailing market price, which is 100. They get that amount. When the price falls, they're going to buy back the shares. So they buy back their 100 shares at 90 Kenya shillings and return them back to the broker. So basically, that's a simple illustration of short selling.